Hey guys, this is Mark from TRADEPRO Academy, and in this weekend's video, we're going to take a look at range bar charts. So grab a coffee and let's get at it. All right, traders, so here we are back on my Sierra chart platform, and what you see in front of you is a 10-tick range bar chart of the Dow futures. We're going to be spending time in this video introducing the concept of range bar charts and why we use them so heavily in our trading strategy. But first, let's go over how these range bars are calculated. So the first thing to note about range bars is that they take only price into consideration. Therefore, each of the bars represents a specified movement of the overall price. Most traders and investors might be familiar with viewing bar charts or candlestick charts that are based on time. For instance, you can have a 30-minute chart where one bar shows price activity for each 30-minute time period. These time-based charts will always print the same number of bars during each trading session, regardless of volatility, volume, or any other factor. Range bars, on the other hand, can have any number of bars printing during a trading session. During times of higher volatility, you'll likely see more bars printing. Conversely, during periods of lower volatility, you'll likely have fewer bars printing. So what are the benefits of using range bar charts? Firstly, we like to use range bar charts because they help us see market structure and rotations a little bit more clearly. And due to the fact that we've eliminated time from the equation, if we spend, say, 60 minutes in the same price range, but we don't move a single tick, we'll still have only one bar. Whereas with candlesticks or bar charts, this would be a bunch of data points and can get a little bit confusing. So the real benefit of range bar charts is that no new candles form if price is not moving. And this is important to us as traders because we can only make money when the market moves. So if there's no opportunities, there's no trades. And this is what range bars help us identify. So now that you're familiar with how they're calculated and some of the benefits behind range bar charts, let's take a look at how they actually form. So there are three main rules when it comes to range bars. The first being that each range bar must have a high and low range that equals the specified range. So what that means is that if you have, for example, a 10-tick range selected, each of these range bars is going to be equivalent to that range. So each of these range bars is equivalent to 10 ticks. So you've got 10 ticks here, 10 ticks here, 10 ticks here, and 10 ticks here. If price does not move out of that 10-tick range, a new candle does not form. So this kind of helps us identify consolidation areas and levels where price is likely to range for a little bit before continuing in either direction. The second rule is that each range bar must open outside of the high-low range of the previous bar. So what you'll see here is that when this bar closes, the open is always above that range in the case of price action moving higher. In the case where price action moves lower, you'll always see the open below the previous bar's low. So in this case here, you can see we had a close on the low, open below that low, another open below that low, another open below that low, and the trend continues until price finds some support, rotates sideways, and then we see a little bit of a rotation back up to the upside of that range. So that is rule number 2. Each range bar must open outside of the high-low range of the previous bar. The final rule with range bars is that each range bar must close at either its high or its low. If you take a look at any of these bars, one thing that you'll notice immediately is that there are no upside or downside wicks or dojis. A range bar can only close at either the high or low. So there will never really be a situation where you have a downside wick, the open and the close in the middle, and an upside wick. There will only ever be a wick to one direction of the bar. In the case where it's a down bar, the wick will be at the top and it will close at the bottom. In the case if there's a wick to the downside, the bar will close at the top. That is basically how these range bars are formed. So now we'll conclude the video with showing you an example of how to identify support and resistance utilizing the range bar charts. So if you take a look at these charts, what you'll want to see is essentially a level that price is having trouble penetrating above or below. So what we're seeing here is that this level right around the 25,470s was a pretty good level. You can see we had a couple of rotations and buyers were really unable to force the market to bid back up over that VWAP. So this could be a good level of potential support and resistance in the future. Right around that level, if we extend the drawing out, you can have that. And then for support, you can see that we kind of traded down into this level here and found a little bit of buying, and then we sold back down into it, found some buyers again, and rallied out of it. So this can also be considered a pretty good level of support and resistance. And let's extend that through, and we'll extend that to both sides here. Now that we've identified those levels, what you'll want to do is let the market do its thing and trade into them. And if we move the chart over to the current time, which is around 3 p.m. on March the 7th, you can see that we had a couple of opportunities based on these quick zones that we drew in here. We had price kind of form a double top right above that VWAP. We had the breakdown below it. You can see we had some support in this level, broke through that, and then had a retest into that level where buyers were unable to push price higher and the sellers stepped in and rotated the market lower. So right in there, there's a great opportunity to short from those 470s down into those 420s. It's about 50-point move there, or rather 50-tick move on the Dow futures. And again, we held rotations here, so there was a little bit of buying interest, but ultimately the market gave in and breached those lows. And you can see that we've been testing it as resistance for the last couple of rotations, and we haven't been able to break back above that. So this could be seen as a potential level for short sellers to get positioned for a continuation move lower. So I hope you guys enjoyed that little intro to the range bar charts, how they're formed, how they're calculated, some of the benefits behind using them, and this quick example of how to identify support and resistance using the range bar charts. So if you guys did enjoy this video, please do us a big favor and like the video, share your comments and thoughts in the comment section. Let us know what you guys want to see going forward so that we can continue providing value to you. And finally, if you guys know of a friend, a relative, a family colleague, anybody that's interested in trading but doesn't really know where to begin, kindly send them over to our YouTube channel and to our Facebook group, TRADEPRO Academy Trading Floor, where we continue to provide you guys content and value on a daily basis. So until next time, good luck and good trading. Take care, guys.